Radio Chutney, you're tuned in with me, RJ Hemani. And of course, today we have Jagariti Mathur, once again, founder, R Accounting Solutions, your one stop shop to all things financial, all things entrepreneurial, anything related to tax planning, starting your startup. And today, Jagariti is going to be talking about a very interesting topic. Now, with the Indian startup ecosystem flourishing, there is a significant rise in innovating startups emerging across sectors, eager to showcase their businesses and attract strategic investment. And with
Yeah.
increasing opportunities to foster collaboration, people across countries have taken proactive steps to encourage entrepreneurship and promote investments into Indian startups through various initiatives and regulatory support. This environment presents an exciting opportunity to foster collaborations between startups, investors, and enablers, creating a vibrant platform for growth and value creation. So, my very first question to Jagrati is going to be, what are the available ways to attract investment in the business?
Hi, Himani. As you rightly said, yes, the startup ecosystem is thriving and we should not miss the bus. So, let me answer the question that you asked me. What are the available ways to attract investment in the business? So, for founders to attract investment in their business, the ways they can attract investment in their business are through angel investment, through venture capital funds, through accelerators and incubators, there are government grants and schemes, there are crowdfunding platforms, family offices, etc. Now, let me give you a brief overview of what all these things are. So, basically, angel investors are those early stage investors who are looking for high potential startups to invest since inception. Venture capital funds are the institutional investors funding startups ready for growth and scale. Accelerators and incubators, they have these structured programs offering early funding, mentorship, and exposure. Government grants and schemes, they are funding through various programs, like if we talk about Indian ecosystem, Startup India Seed Fund. There are different countries who have different funds, so on and so forth. Then we have corporate venture capital firms. So these are strategic investment from large companies. Crowdfunding platforms, they raise smaller amounts from a wide group of retail investors. And family offices are the basically family offices is when you have money coming in from flexible sources, long-term funding from private family investment arm, private family office, and he's investing in your business. So these are the ways to attract investment in your business.
All right. Well, my next question is, of course, the most obvious question, that investment instruments for Indian startups. What are them? Some key investment instruments.
Okay, so I will make this very quick. I'll divide it into three parts. Okay, so the investment instrument, what is that? What type of ecosystem is it good for? What type of startup is it good for? And the word of caution involved. Okay, so very quickly, first instrument is equity instruments or equity investment, which is straight equity. So what is it? So a startup in this has to issue shares immediately at an agreed valuation. Okay, so if you are ready to do that as a startup, then equity or straight equity is for you. It is good for clear valuation and readiness to dilute ownership. So if as a founder you are ready, you have a clear valuation and you are ready to dilute your ownership, then equity investment is good for you. What you have to be careful about is it'll immediately dilute, and valuation is the key point, right? The valuation has to be finalized. So you have to make sure you really know where you have to place your company's valuation. You have to have that strategic outlook. Second instrument is CCPS, compulsory convertible preference shares. What is this instrument? So basically, you issue preference shares now and you convert it to equity later. When you have a next round or when you have exit, then you convert them into equity. So it is good if you require funding now and you want to dilute later, with investors. So basically, it gives investor that protection that, okay, I'm not getting equity now, but when I'm exiting the system, my preference shares will be converted into equity. So now, word of caution in this is that you need to have strong legal agreements. Your SHAs and SSAs needs to be very strong if you're getting into this kind of arrangement. Next arrangement is iSafe. This is a very, I would say, stable or a very safe kind of arrangement. That's why it's called iSafe. So iSafe note is basically it's just an agreement for future equity. So if a startup, for example, doesn't have a valuation today and they want that, okay, at a later date, when I see that I can have a better valuation, I'll give you this at a discounted rate at an agreed valuation that we agreed before. So it is good for fast, founder friendly, early stage fundraising. Okay, when you don't have the valuation but you have a very strong business idea and you don't want to value a company now because you see that, okay, I can get more money later, a better valuation later. So caution is that it is not preferred by traditional investors, okay, because it has a element of uncertainty involved. So traditional investors are not very keen on iSafe note. Then it's a CCD. So what is CCD? It is compulsory convertible debenture. So basically, it's a debt. It's a debt instrument which says that, okay, I'll be, it's an option to convert an equity after a specific event or a time. So you say, okay, after 5 years, this converts to equity. What is it good for? It is actually good for the bridge rounds, right? So if you have a structured conversion, then for the bridge rounds, this kind of CCD arrangement is good. Now, the word of caution for this is that it is very compliance heavy, especially foreign funds are involved. So you need to do your compliance very well if you're getting into CCD. Then next is convertible note. So convertible note is basically it's a loan with an option to convert into equity or to be repaid. So either you repay it or you convert it to equity. So it is suitable for early stage startups who are raising small amounts. But if you talk about Indian diaspora, there's a limit. You need to have a value of minimum 25 lakh or above per investor. So that is a limitation for the Indian setup if we talk about. And the caution is that there's this regulatory cap of 25 lakhs there, and it's not suitable for larger rounds.
Jagariti, are there any compliances involved in all of this?
Yes, definitely there are compliances involved in all of this. So if we talk about equity investment, then the compliance requirement for equity investment is that you have to get for all of these, actually, you need to get your board meetings done. You have to get your filings in order. You need to make sure that your certificates and your agreements are in place. If you're dealing with foreign shareholders, especially if we talk about from India perspective, your FCGPRs and everything is in order. So we need to make sure that your SSA, HSA, your agreements, everything is in order.
Okay. Jagariti, of course, I'm going to ask you some tips that you can give founders. But before that, how can our accounting solutions help in all of this that you just mentioned?
Okay, how can our accounting solution help? Is our accounting solution can help you with your fundraising structure. We can help you with your legal documentation, your regulatory compliance management, your investor relation readiness preparation. So we can basically, our accounting solution can be your partner to simplify fundraising for you to ensure regulatory excellence and scale your startup with confidence.
Fantastic. And any tips to founders that you want to give?
Yeah, so tips to founders would actually be make sure that your board resolutions and agreements are drafted early. Okay, so don't keep this task for the last minute. Make sure that your ROC filings are done. If we talk about Indian ecosystem, if you're having any foreign funds, make sure that your RBI filings are done on time. Okay, otherwise fund approvals get delayed. You can attract heavy penalties if your filings are pending. And the biggest bottleneck that we have seen till now is that board resolutions, agreements, if they're not drafted early, there's a delay because of that. And then the term sheet signing gets delayed. So basically your funding gets delayed. So make sure you take care of all these things. And if you need any help, we are there to help you forever.
Wow, complex topic, a lot of complex terms, but yet a very, very important, essential, and much needed tips from Jagariti about everybody who's interested in entrepreneurship or thinking about having their own startup. Of course, you can get in touch with Jagariti personally, one-on-one, with the details mentioned in this post and right here below as well. And she'll help you out with any doubts, any questions, any solutions, or just have a chat and know what funding a startup or even starting your startup is all about and what does it take. Thank you so much, Jagariti. As always, pleasure talking to you. Thank you so much for talking to Radio Chutney.
Thank you so much. Pleasure is all mine. Thank you.